What if I told you that for 30 years, the world's biggest banks were secretly rigging the price of money itself? Your mortgage, your student loans, your credit card debt, all of it manipulated. And they got away with it for decades. If you want to uncover more buried secrets from the world of finance, hit that subscribe button right now, because on Monetary Archaeologist, we dig up the truth that powerful people tried to bury. Let me ask you something. Do you know what LIBOR is? Probably not. And that's exactly how they wanted it. For most people, LIBOR was just another boring financial acronym, something that sounded important but didn't really affect normal life. Except, it affected everything. Your car payment, your mortgage rate, the interest on your credit card, even the loans your government took out to build roads and schools. LIBOR stood for the London Interbank Offered Rate. And it wasn't just some random number, it was the price of money itself. Let me explain what that actually means. Every single day, the biggest banks in the world, names you definitely know, like JPMorgan, Citigroup, Barclays, Deutsche Bank, and UBS, they all got asked the same question. If you had to borrow money from another major bank today, what interest rate would they charge you? Each bank would send in their answer. Just a number, a guess, really. Then, someone would throw out the highest and lowest answers and average the rest. That average became the official LIBOR rate for the day. Sounds simple, right? Here's the problem. Those numbers weren't based on actual transactions. They weren't based on real data. They were based on trust. The assumption that trillion-dollar institutions would simply tell the truth. And in the world of high finance, trust is the easiest weapon to use against everyone else. Now, you might be wondering, why does this matter? It's just some banking rate, right? Wrong. LIBOR wasn't just important to banks. It was the foundation underneath $350 trillion in financial contracts worldwide. Yes, trillion with a T. When you paid interest on your mortgage, LIBOR influenced that rate. When your student debt grew every month, LIBOR was part of the calculation. When entire countries borrowed money from each other, LIBOR was the invisible reference point deciding what everything cost. Economists called it the world's most important number. It was the heartbeat of global finance. And this heartbeat was controlled by a handful of banks who submitted numbers based on, well, whatever they felt like that day. Think about that for a second. The entire global financial system was running on an honor system. It's like letting students grade their own exams and then giving them bonuses based on how high they scored. At first, everything seemed fine. The system worked. It was stable, efficient, self-regulating. But inside those banks, something quiet was happening. A realization was spreading among traders. If even a tiny change in the LIBOR rate could move trillions of dollars, then whoever controlled that number had real power, invisible power. The kind of power that could make you insanely rich. And power like that, it never goes unused. So how did they actually manipulate it? Let me break it down in the simplest way possible. Imagine 16 banks are asked what rate they'd pay to borrow money today. They each send in a number. The top few and bottom few get thrown out. The middle ones get averaged. That average becomes the official LIBOR. Now imagine you're a trader at one of these banks. You're holding a massive financial bet, a derivative contract that pays out big if interest rates go up or down. If you know LIBOR is going to rise tomorrow, you can set up your trades to make millions. But here's the thing, why wait for the rate to rise naturally when you can just push it yourself? So you send a quick message to your buddy who works in the department that submits the daily LIBOR rate. Hey man, can you lower the number a bit today? I need it down just a few points. Your friend agrees, adjusts the number, sends it in. When all 16 banks submit their rates, that tiny adjustment shifts the average. LIBOR drops, maybe by 1/100%. Doesn't sound like much, does it? But when $10 trillion in contracts are tied to that number, even 1/100% means billions of dollars move instantly. And every time the rate moved in the right direction, the traders who nudged it collected the winnings. It wasn't complicated. It was subtle, quiet, almost invisible. And that's what made it perfect. Because nobody was checking, nobody was watching. The British Bankers Association, which oversaw LIBOR, just assumed big banks would never lie. Regulators in London and New York trusted the system, and for decades, everything seemed totally fine, until it wasn't. By the early 2000s, this quiet manipulation had grown into something much bigger. It wasn't just one or two traders bending the rules anymore. It was open coordination, secret alliances, full-blown collusion. Traders across different continents started working together in private chat rooms. And they gave these chat rooms names like the Cartel and the Mafia. I'm not making this up. When investigators finally uncovered these conversations years later, they couldn't believe what they were reading. These messages sounded like bad dialogue from a heist movie. Here's a real example. Can you move the 3-month LIBOR down a tick today? Sure, mate. No worries. You owe me a bottle, though. Cheers. I'll push it up tomorrow. Gotta balance the books. They joked about fixing the fix. They sent each other champagne, tickets to Wimbledon, all while moving billions of dollars that affected everything from city pension funds to family mortgages. This wasn't some rogue trader going crazy. This was routine, standard operating procedure, business as usual. And that's what made it so terrifying. Then 2007 hit. The housing market started cracking. The financial system, loaded with risk nobody fully understood, began to wobble. And LIBOR, the number that was supposed to measure trust between banks, became complete fiction. When the global financial crisis exploded in 2008, banks stopped trusting each other. They were too scared to lend. But they also didn't want anyone to know how scared they were, so they lied. They kept reporting low borrowing rates, pretending everything was healthy and stable. In reality, the interbank market had frozen solid. Nobody was lending to anybody. The system's heartbeat was flatlining. One economist later described it perfectly. He said LIBOR was the thermometer that said 98 degrees while the patient was in cardiac arrest. Banks lied to save face. Regulators looked the other way to prevent panic. And the world kept using a number that had zero connection to reality. The irony was almost poetic. The index created to measure trust had become the ultimate symbol of deception. The truth finally came out in 2012. A combination of whistleblowers, investigative journalists, and regulatory pressure forced the scandal into the light. It started with Barclays Bank, which admitted to rigging LIBOR and handed over chat transcripts to authorities. The tone of those messages was shocking, not because of what they revealed, but because of how casual it all was. These weren't criminal masterminds. They were regular traders joking about distorting the global financial system like it was a fantasy football league. When regulators questioned one Barclays employee, he said something that still sends chills down my spine. "We all did it." And he wasn't exaggerating. The scandal spread like wildfire. UBS, Deutsche Bank, JPMorgan, Citigroup, Royal Bank of Scotland, all of them got caught. Every single one had manipulated LIBOR either to profit from trading positions or to make themselves look stronger during the crisis. This wasn't one bad apple. This was the entire orchard, rotten from the roots up. Regulators around the world launched massive investigations. Governments demanded accountability. But by that point, the damage was already done. Not just to markets or institutions, but to trust itself. For 30 years, the world's most important financial benchmark had been built not on real transactions, but on guesswork. Not on honesty, but on opportunity. And the greatest illusion of all? That the system would police itself. When the investigations kicked into high gear, the scale of what they uncovered was almost unbelievable. This wasn't a single fraud, it was a culture, global, coordinated, normalized. Internal emails from multiple banks revealed the same patterns everywhere. Requests to adjust rates, favors traded between departments. Managers who knew what was happening, approved it, or just pretended not to see. It was organized crime in suits, the polite version. No ski masks, just spreadsheets. Barclays cooperated first, hoping to reduce their penalties. But that only confirmed what regulators feared most. The corruption wasn't isolated, it was everywhere. UBS, Deutsche Bank, JPMorgan, Citigroup, Royal Bank of Scotland. One by one, they all fell. Each had been submitting fake numbers, gaming the system to boost profits or appear healthier than they actually were. By the time everything was settled, the fines totaled nearly $9 billion. Sounds like a lot, right? But here's the thing. That number is basically meaningless compared to the profits this manipulation generated. Even a 1/100% change in LIBOR could shift billions across global markets. $9 billion in fines? That was just the cost of doing business, an accounting entry, a rounding error. A few traders got charged, some even went to jail. But they were scapegoats, the visible tips of a massive, invisible iceberg. The institutions themselves? They survived just fine. Executives resigned with golden parachutes, bonuses kept rolling, and within months, it was business as usual. The markets barely flinched, investors shrugged. Most of the public didn't even understand what had happened. And that's part of the genius, isn't it? When the crime is too complicated to fit in a headline, accountability just dissolves. To really understand how this scandal could even happen, you need to understand how finance prices risk. Interest rates are supposed to reflect trust, the cost of lending money when you're not totally sure you'll get it back. LIBOR was supposed to mirror that trust between banks. But when the entire global system tied everything, student loans, mortgages, corporate debt, sovereign bonds, to that single number, it created a dangerous dependency, a dependency on honesty. And the moment honesty became optional, the whole thing collapsed. Traders didn't need to hack anything. They didn't need to break in or steal files. They were the system. They understood that financial markets don't run on morality. They run on incentives. And the incentive was always profit. The more important LIBOR became, the more profitable it was to distort. The mechanics were deceptively simple. Imagine you're a trader holding a huge portfolio of interest rate swaps, contracts that let you bet on whether rates go up or down. If you know LIBOR will be set lower tomorrow, you position your trades in advance and cash out when the rate moves. The trick? You don't need insider information. You just need a friend. Someone in the department that submits the rates every morning. One message, one small favor, one tiny adjustment. And trillions of dollars move invisibly. The beautiful or horrifying part of this system is that it left almost no trace. LIBOR wasn't set by public auctions or transparent data. It was a survey, a daily poll where bankers filled in the blanks however they wanted. When you give absolute discretion to profit-driven institutions, you don't get objectivity. You get choreography. Even during the 2008 financial crisis, when the world was literally collapsing, the illusion continued. Banks that couldn't borrow money in real markets kept submitting low rates, pretending everything was fine. Regulators saw the numbers and chose to believe them. The lie became the official story. Because the market needed calm, not truth. And in the world of finance, stability always beats honesty. When the scandal finally broke wide open, governments faced an impossible choice: expose the full extent and risk destroying faith in the entire system, or contain it quietly and move on. They chose containment. Committees were formed, reports were written, fines were paid, and a new rate was promised, one based on actual transactions instead of estimates. LIBOR, after decades as the benchmark of the global economy, was officially retired in 2023. Its replacement is called SOFR, the Secured Overnight Financing Rate. It's based on real data from U.S. Treasury transactions. In theory, it's cleaner, safer, more transparent. But here's the uncomfortable truth. SOFR still depends on the same institutions, the same incentives, the same culture that made LIBOR possible in the first place. The names changed, the behavior didn't. Because the LIBOR scandal was never really about interest rates. It was trust. The kind of trust that holds up every financial contract, every central bank decision, every pension fund, every retirement account. The kind of trust that doesn't collapse with explosions or dramatic headlines. It collapses silently, with emails, with spreadsheets, with tiny percentages that nobody bothers to double-check. When you think about how the financial system works, it's easy to imagine it as cold and mechanical, algorithms, data, charts. But underneath all of that, it runs on human psychology, greed, fear, reputation, the pressure to hit targets, the thrill of beating the market. LIBOR turned those impulses into numbers, and those numbers into power. That's why this scandal was so dangerous. It didn't just distort prices, it distorted reality. When a banker submits a false rate, he's not just changing a statistic. He's changing the reality that millions of people live in. Higher mortgage payments, tighter credit, deeper national debt. The manipulation of LIBOR wasn't victimless. It was a silent tax extracted from every borrower in the world. And yet, it barely made the evening news, because the victims were invisible and the villains wore expensive suits. There were no dramatic collapses, no smoking guns, just fractions of percentages, invisible but compounding, quietly siphoning wealth from the many to the few. That's the genius of systemic corruption, isn't it? It hides not in chaos, but in order, in the routine, the standardized, the benchmarked. When deception becomes part of the daily process, it stops looking like crime. It just becomes how things work. In the end, the LIBOR scandal revealed something deeply uncomfortable. The global financial system isn't built on precision. It's built on confidence, the belief that everyone involved is playing fair. When that confidence cracks, the numbers keep printing, the screens keep glowing, but the foundation crumbles underneath. The price of money isn't just a number on a screen, it's a story about who decides, who benefits, and who believes. LIBOR's collapse was a brutal reminder that the people who control the world's money don't need to break the rules. They just write them. And maybe the most unsettling truth of all? The manipulation never really stopped. It just evolved. Buried under new acronyms, new regulations, new benchmarks. The names change, the profits stay the same. The cycle continues. The LIBOR scandal wasn't a glitch in the system. It was the system, stripped of its disguise. Trust turned into a tradable asset. Honesty priced out by efficiency. And the world moved on, because admitting how fragile everything really is would mean questioning the entire foundation of modern wealth. History doesn't repeat itself exactly, but it does recycle the same patterns, the same lies, the same illusions. Each generation inherits the same myth, that markets are fair, that numbers are objective, that corruption is rare. But the LIBOR story shows us what happens when trust becomes just another financial product, leveraged, traded, sold, until it collapses under its own weight. So what's the lesson here? Maybe it's this. The most dangerous lies aren't the ones shouted from rooftops. They're the ones whispered in boardrooms, typed into spreadsheets, embedded into systems so complex that nobody bothers to question them. The world runs on numbers we're told to trust, rates we never see calculated, benchmarks we assume are honest. But what if they're not? What if the next LIBOR is happening right now and we just don't know its name yet? That's the question worth asking. And that's exactly what we do here on Monetary Archaeologist. We dig up the past to understand the present. Because the money trail never disappears, it just gets buried deeper. If this opened your eyes to how the system really works, do me a favor, hit that like button and drop a comment below. Tell me what financial scandal you want me to uncover next. And if you haven't subscribed yet, now's the time, because there are a lot more buried secrets where this came from. Thanks for watching. Stay curious, and I'll see you in the next one.